Hi everyone, I am Amit Gupta. I am a fund manager in the portfolio management service of ICICI Securities. So we are starting, the market outlook on a monthly basis now. And how do we see the market? Because markets have become very volatile. It is always better to, see through our clients through this volatile phase and let us see various opportunities on the macro, on the sectoral front, on the stock specific front. That will be our motive actually in this particular small presentation going ahead. So let us see the current macros, what they are looking into, and also, from the earnings perspective, because ultimately whatever happens in the market, whenever the dust settles, we see whatever is happening to the earnings, ultimately that is a major driver. The other things like, inflation, interest rate increase, it definitely hurts the valuation part of the market. But when the dent is already done, then we should start looking at, if the earnings are still persisting, if the things are coming back, the demand is coming back, then obviously we should start buying in the markets and look for the long-term perspective equity formation. So if you see right now, amid all the volatility, what we have observed, this is very interesting. I mean, generally people say that in the higher commodity cycle, the earnings in index in Nifty generally, are getting downgraded. Actually, it is a myth, because if you see all the major cycles, 2003, 2008, that was also the higher commodity cycle, because we saw in that period, China was building up the cities. There was a huge demand for materials, metals. Now, the last decade of 2010 to 2020, there was hardly any commodity cycle. We saw the interest rates also almost zero. There was a global slowdown actually near 2018. If you see from 2014 till 2020 in this particular chart, the EPS of Nifty was almost flat. It was just around 430 rupees actually per share. And since then, when this commodity cycle amid the pandemic has started, we have seen that the EPS on every quarter basis, it has started growing. So markets have also responded. It is not like the markets have not responded. But now if you see the last 1.5 years, and particularly the last from October onwards, when the market made a high around 18,600 and Nifty declined. Nifty though remained very resilient, but eventually it declined. But we saw the EPS of Nifty remain very resilient. And if you can see here, every quarter basis, we have seen new top being formed by the EPS of Nifty. So it's very obvious that when the EPS is growing and the price has corrected, obviously the worry which we had in the month of October, that valuations were very steep, and people started talking about that at these steep valuations, markets are very risky. Obviously, the markets also declined. We saw the FII profit booking started more severely when the Russia-Ukraine war started from the month of Feb. And if you see now, after all this correction, mid-cap indices declined, small-cap indices declined by more than 20%. Nifty also declined from 18,600 to I think close to 15,000. So in this chart, if you see, the EPS has been continuously growing. So on a rolled EPS, we saw after every quarter, we saw that how the EPS on a 1 year basis, on a 1 year forward basis has been growing. So we saw EPS was growing. And when the price declined, you can see how there has been contraction in the price to earning. So from almost 22.8 times 1 year forward, it declined to 18. In fact, when it came closer to 15,200, that was a time when it declined closer to 17 times price to earning. So it was lower than 5-year average, and it was actually very close to the 10-year average. So that is where the markets worry in the month of October of very high valuations. So to some extent, it got sorted out. And now near 15,000, obviously it was a very lucrative scenario, at least from the fundamental perspective, despite all the macro headwinds. A level came actually for a good investment for a longer term perspective. If you see from a trailing EPS perspective, trailing EPS, the last 12 month EPS, which is what happening in the market, not what we are projecting. So when we look at the last 12 months, so obviously you can see how the price to earning has declined. It has in fact came closer to 2014 and in fact came closer to 2010 levels also. So last 10 years, 12 years of price to earning levels became equivalent, and it happened. And though when we see Nifty, it does not look like we had such a heavy correction, but because the EPS was growing and the price was declined by close to 3,000 points, this all happened because of that. So there is a sharp contraction from 35 times to almost 20 times on a trailing EPS basis in Nifty. So this is where, when we are looking for investment in equity market, this is one of the premise that we always look for while putting our money. Whatever happens, whatever volatility happens, this is one thing actually which always helps when we are investing in the markets. Important part of the index, which is banking, because banking holds a major chunk in Nifty, in Sensex. We have seen that the banking NPAs, which were very high 4 or 5 years before, obviously they have got corrected. So NPAs have declined very sharply. If you look at the period of 2018, out of a total base of 100 lakh crores, we had 12 lakh crores, almost 12 lakh crores of the NPAs in the system. And now if you see on a growing base of, I think, around 120 lakh crores, you have a NPA of around 7 lakh crores, close to that. So NPAs obviously on a growing base also, they have declined. We had seen a rough phase for the banks in between, when obviously the DHFL problem came, the IL&FS problem came, the Yes Bank problem came, but the banks have lived through all this difficult period. And we saw that now if you look at the provisioning coverage ratio of the banks, of the larger banks, it is around 75%, which is very comforting. And this is where the balance sheets of the banks look quite strong. If you see, because of this, now see the earnings of the banks, because eventually we saw that the bottom line has started improving. Basically, there are two major pillars for banking, which I generally discuss with my clients. One is the NPA cycle. It should start coming down, which happened, and because of which the banks made the bottom. The other is the increasing credit growth, which was missing actually the last year. So last year we had 5% of credit growth in the banks. But now if you see the last 2 quarters, it has really increasing actually now. It has come closer to 11%. So I think when the bank's credit growth is improving, it is obviously a sign now whenever the FI flows starts coming back, this risk of sentiment stops. We will eventually see that the banks will start moving back. If you see the annualized earnings from 2019 to 2020, 2021, we have seen the bank's earnings have started improving now. In a rising interest rate cycle, obviously the lending rates are increased first, then the deposit rates. So we have seen the NIMs improve. We have seen in a higher inflationary scenario, the working capital requirement improves, and that increases, and that is where the banks go to, the corporates go to bank for borrowing. That increases the credit growth. We have seen the bond yields have moved up very fast. They are factoring in even the 2023 rate hike right now. And that is the reason actually when a corporate wants to borrow money through commercial papers, their yields are higher. So they will always go back to bank to borrow money. And that is where also the credit growth increases. Third, we have seen, some capex started from the private side. From the public side, obviously the government had put a lot of money into the capital expenditure. But now from the private side also, because the current capacity utilization in the industry has improved. It was just 60% when we were coming from the pandemic, but now it has gone more than 70%. And that is the reason some industries are much higher. they have 75-80% of capacity utilization, and that is where they have started announcing the capex. So this is what I was talking about. If you see the current capacity utilization, it has gone to 72.5% right now, and it is continuously improving. So this shows the demand also, that the demand in the economy is coming back despite all the hiccups that we have seen. Many sectors actually have seen a very strong demand because very less discretionary spending happened when we were in the pandemic, and because of the government expenditure also, we are seeing in the industrial space also that kind of order book addition is seen. If you see the GST collection, this is definitely giving more wings to the government. Previously, if you remember, hardly 80,000 crore of GST we used to see. Then there were many fingers which were raised that how this figure will be improved. Last year, I still remember, more than 500 crore turnover corporates, it was mandatory for them to do the digital invoicing. But now from 1st of April, even more than 20 crore turnover corporates, they have to do the digital invoicing, which is mandatory. I think this is something which is exceeding what the government has been projecting in the budget. If you see, this is the monthly average for all the years. Last year, it was expected that GST on an average monthly basis will be around 1.05 lakh crores. Actually, it came out to be 1.24 lakh crores. And now, this year, the financial year 23, the government has raised the expectation to 1.3 lakh crores. If you see the last 3 months, 4 months, we are seeing the figures coming above 1.4 lakh crores. So it looks like going forth, because more and more individuals, corporates, they have been added under GST. So it looks that going forward, government has a good cushion actually of expenditure that they can do with the help of this flow. If you see the current account situation of India, it is obviously better than before. When previously the tightening happened, the stimulus reduction happened in the year 2013 by US, we had a current account deficit of -5%. Now, when it has started, you can see that we are much better placed. In fact, our software export now has exceeded the crude oil import. We had a good forex, though it has reduced by $45 billion in the last few months. But eventually, this particular positioning of India is much stronger than before. And it has come on the back of new reforms from the government, which are expected to bring good forex actually in the country going forward. We have seen not only the domestic industries, but also the MNCs, they are very, very interested in opening up their businesses in India. The FDI flows will improve. You can see Siemens, Apple, so these manufacturing plants being opened. We have seen the PLI benefits given by the government wherever the China +1 kind of inflow is coming from the industries. So this is where we believe that if crude remains around 110, now recently you have seen government on a fiscal front, they have acted, just not like on the monetary front. On the fiscal front, they have started putting some duties. They put the duty on wheat. They put the duty on gold import. They put the duty actually on steel export. And before that, they had reduced the VAT on fuel taxes. So when the VAT was reduced on fuel taxes, there was again the fingers were raised about the fiscal deficit. Government has given 6.8% of fiscal deficit target for financial year 23. So it looked like their flows will get weakened because when the VAT was reduced, but now they have acted on the fiscal front also. And this is a balance which the government has to carry forward along with the monetary policy. You just cannot keep on increasing the interest rates, because in India, the inflation looks like still it is in control than what it is there in the developed nation like US. We have monsoon also coming back. Monsoon looks better. This is the 4th year in progression when the monsoon looks better. It was deficit, but it is recovering again. And if everything goes fine, last year we had food grain that was a record high acreage production. The same thing can happen this year also. Government is very agile, very fast on the ethanol blending. If you see, 10% was the target for 2022 ending, but they have done it much before, during the year itself. And now another 3 years, they have to make it to 10% further. So make it 20%. So obviously there will be more ethanol production. There will be more acreage of other crops, whether it is sugarcane or corn and etc. So this is where the farmer's income, if it starts improving, it will also help in the domestic growth, in the domestic demand perspective. So all of these things, are covering this particular macro very well and are likely to cover this macro very well going forward. So we have to watch it. Obviously, if crude goes beyond a certain limit, then it is tough. But then again, obviously the market, if you look at whether the Russia supply has reduced, currently it is not the case. Why the crude is elevated? Because it is a fear that tomorrow or after 6 months, if the supply of Russia starts reducing to Europe, then what will happen? Because there is no replacement to the Russia supply yet. Iran sanctions, if US lifts off, then it can, bring the crude down. US elections are also there in the month of November. But if that does not happen, because higher crude prices are pinching the US citizens also. So we have from $3 or $2.50 to more than $5 per gallon prices in US. So this is where Mr. Biden also met with Saudi president, and the Saudi started, OPEC has spoken about increasing the supply. So these are the things which are, covering crude. Crude is still around $110 when I talk about Brent. It has not come down what other commodities have seen. So we have to see this particular thing going forward, and that is where markets can remain range bound, though the downside in the market looks limited. This is one feature which generally happens when there is a risk of sentiment and the dollar has started moving up again. I have seen historically, whenever dollar starts surging, there is always a risk of sentiment. So it has started from the war. Till this war is on, obviously this thing can remain intact. And that is one thing which is leading to the depreciation of Indian currency also. And you have seen even some developed nations' currencies also, have depreciated. And if you look at the flows from emerging markets towards emerging markets from the FIIs, obviously the money is going into the commodity producers. If you see here, year till date, it is Brazil, Canada, Malaysia, Indonesia, where the flows have gone actually. Otherwise, rest of the commodity users, generally we have seen the FI outflows have happened. Brazil, when we talk about Brazil, so they are already using ethanol in a very larger content. The same India is also trying to do. Canada is also the oil producer. Indonesia, because there is some restriction on the oil from Russia, so we have seen palm oil from Indonesia has come in demand. That is helping actually these economies actually currently from the FI flows perspective. So if you see from the currency, from the dollar surge perspective, basically from the developed nations, we have seen euro and yen. There is a very huge, depreciation. I mean, euro was supposed to be previously at 1.25, and now it has come down to 1.04. Obviously, it indicates the weakness also in this particular economy, and that is the reason they have not been able to take final call on the Russian gas supply also. When we look at yen, Japanese yen, that has also depreciated actually to almost 135. And the reason being because of higher gas prices, they are continuously giving a stimulus in the country. And now they are talking about almost 10 trillion yen, almost $77 billion actually of stimulus to be given. That is the reason actually the yen depreciation is seen. Brazilian real is quite resilient because I already discussed the FI flows which are going into the commodity producing nations. Our currency, because of our domestic macros and the government reforms, it was very resilient. But recently we have seen that USD INR has started depreciating. So this is one of those phases when the dollar has direct impact on our currency, and that is what we are seeing. But it all depends upon the crude movement. If crude starts stabilizing or coming down, then obviously the rupee depreciation can also stop. Now coming to the another major worry, when the interest rates are increased almost by 75 bips by US in a single month, and again they are talking about another same quantum hike. What are the four major worries for global slowdown, what we are expecting? So major reasons have been the supply chain disruptions, labor shortages, elevated material cost, or generally we talk about commodity prices which were high, and the interest rates which increased very sharply in the very short span of time. Let us see all of these 4 points one by one with the data points. The supply chain disruptions, when we look at the chips or semiconductor availability, that was very high, and our auto companies faced that particular brunt. But now with the China opening, despite the war continues between Russia and Ukraine, but with the chances of China opening, we have seen that the supply disruptions actually have come down. That is the reason actually, if you see the automobile in India, that particular sector has started reviving. There has been good sales, 25% jump we saw in the month of June, and the stocks have started recovering. We had Mahindra in our portfolio, in our ACE equity portfolio. We had taken the stock near 650 levels before, and we were holding it for the last 1 year. Because whenever we were speaking with the management, they were talking about the increase in return ratios in the company, the international losses in the company by the focus of the promoters. Management, they have already reduced. It was almost 3,300 crore of international subsidy losses, but now it has reduced to below 200 CR. The SUV segment in Mahindra has been a hit. It has increased the market share, whether it is XUV 700, 300, Scorpio or Thar. In tractors, that is the only segment tractor when we compare with 2019, that is higher than 2019 actually. The other segments are still down. So you can see the growth which is coming up in the segments of Mahindra. They have also started the EV of three-wheelers, Triazor. So that can be another push going forward. So this stock is recovering very fast, and it has already made the new life highs. Now, if you see inflation part, and let us see how we can address this in US also, because by the virtue of dollar appreciation and by the virtue of some recessionary talks being happening, in the developed nations, we have seen the commodity prices, whether it is agricultural commodities or it is industrial commodities, they have declined. Aluminium has corrected by almost 35-36%. Copper has also corrected, though copper was lesser corrected because there was a huge demand for power. We have already seen in India 390 gigawatt has been the power demand. So copper has been in huge demand. So I think it has declined lesser. But iron ore prices have declined because of the reduced demand from China, because of the China slowdown. And of late, steel prices have also declined, though initially they were looking more resilient, but now they have also corrected by 17-18%. So these commodities decline obviously will have their role to play in the inflation. Inflation possibly will start peaking out going forward. And if you see US inflation, it has another two major components. One is the wage inflation, which is very vital. You can see the labor participation in US. The people are participating, but still it is lower than before. And that is led to the higher wage inflation in US. The used car prices, they had increased more than 65%, but now we have seen that last year, the same period, the used car prices had started moving up. So when we compare year on year, this inflation number will start coming down. So this is where it is possible that US inflation eventually will find some kind of, headwind now because of these reasons of commodity decline, more labor participation if it is slowly happening, and the used car prices also, decline. Now, another worry I just take of interest rate increase. So interest rates increase and the bond yields increase. These two are the things that we need to understand, because bond yields are being traded in the market. They start factoring in the rate hikes much faster. Right now, the bond yields are factoring the rate hikes even of 2023. Let us see the US dot plot. 2022 ending, this is what the median forecast is, that it will be somewhere around 3.4%. 2023, it may be 3.6%. And you can see the 10-year US yield has already gone up to 3.5%. This is something that we need to understand, that whatever negative is coming to equity markets or whatever negative is coming to bond market, it is getting factored. Whenever any statement is coming out, it has a deep impact, and the market starts, forecasting that such things can happen in the future, and the same thing happened in the yields. Now, here you can see that whatever rate hike cycles have happened before, generally near the initial rate hikes, we have seen the bond yields have mostly covered the major length, and thereafter, even if the interest rates are being increased, the bond yields have stopped moving up. So this is US rate hikes 2004, 2006, 2017, 2018. And here you can see that during the rate hike cycle, when the bond yields movement was very restricted. So despite 4% increase in this cycle, the bond yields moved up only by 39 bips. And in the next cycle, despite 2.25% increase, we saw that the bond yields increased by only 79 bips. So it looks like we are reaching a stage, because many things have already been talked about, that bond yields have covered a major expectation of interest rates increases. Now, if inflation starts surprising very high, then it may be a different situation. But looking at the current context, it seems that most of the things are getting priced in. So this is all from our side for today. And this particular month, 15,000 to 18,000 has been the range bound scenario of Nifty so far in the last many months. This time correction has still continued, but we believe that now slowly the time is coming when one should start looking at for some investments, because investments are done only when the decline happens in the index, the things are coming cheaper, the things have become cheaper. Whether they will become more cheap That is something we don't know, nobody knows. But when we are seeing the price PE contraction from 23 times to 17 times, it definitely makes an appeal for some investment in the equity markets. And in our PMS, ACE equity PMS, where we have given handsome returns in the last many months, our approach is the same: to pick the leaders in the portfolio across the market cap and keep on looking at the opportunities, whether it is a government reform process or the market share increase in the stocks, which is very vital, because in a higher inflationary scenario, it is always, possible that when the situation gets tough, the market leaders or the companies which are increasing the market share, whether they are in mid caps or small caps or in large caps, they always create a much better wealth going forward when the market recovers. That is what we are looking at. We have created a portfolio of consistent movers, or generally you say consistent compounders, but along with that, we have added those sectors which have not performed in the last 10-12 years. I think the PE adjustment needs to be done in the portfolios now. You cannot keep a very high PE because of higher interest rates. We have seen that how these sectors have declined wherever the valuations were steep. So you need to combine the market leaders into growth as well as value, and that is how you can keep a good portfolio going forward. And that is the reason this has been a very resilient portfolio for you. And so that is all from my side for today. We can always take your queries going forward. And next month, we will see new data points which are emerging, and then we can answer them. Thank you very much.